Something happened in the silver market that most people are going to misunderstand. They'll glance at a chart, shrug, and say, "Oh, silver went up again," and then move on. That would be a mistake. What just happened was not a normal move, not momentum, not speculation, and not excitement. It was a gap. And gaps are not ordinary price movements. They are confessions. They are moments when the market admits that something underneath it is no longer working the way it's supposed to. When silver gapped higher, it wasn't celebrating, it was escaping. Most people are taught to think about markets in the simplest possible way. If price goes up, buyers are strong. If price goes down, sellers are strong. That kind of thinking misses the point entirely. What actually matters is how price travels from one level to another. In a controlled market, price moves step by step. There are sellers at every level, liquidity is present, and there is negotiation between buyers and sellers. A gap means that negotiation failed. Buyers stepped forward and wanted silver, but the market responded that none was available at that price. So, price jumped to the next level where someone was finally willing to sell. That is not optimism or bullish enthusiasm. It is a lack of supply. And lack of supply is the one thing the paper system cannot fabricate forever. For decades, silver has appeared abundant, not because it is abundant in reality, but because it is abundant on screens. Futures contracts, ETFs, options, and synthetic exposure create the illusion that silver is everywhere and always available. But none of those things are silver. They are promises. And promises work only until too many people want delivery at the same time. What this gap revealed was a brief moment when the promise-based market blinked and reality pushed back. The modern financial system does not directly control price. It controls time. Time allows algorithms to respond, banks to hedge, media narratives to form, sentiment to be shaped, and fear to be distributed slowly and effectively. Gradual movement is manageable. Even sharp movement can be contained. But gaps eliminate time entirely. They compress risk into a single moment and force the system to reveal whether it actually has what it claims to be selling. When time disappears, control disappears with it. This gap did not come out of nowhere. It was prepared. For weeks, the silver market had been under pressure. Rallies were capped, dips were forced, margin rules were adjusted, volatility was encouraged, and confidence was deliberately shaken. The goal was simple: weaken conviction, flush out leverage, and scare people into selling. And that part worked. Weak hands left, speculators reduced exposure, short-term traders exited. What remained was something very different. Ownership shifted. Not all holders of silver are the same. Some hold silver to trade it, some to hedge it, and some because they absolutely need it. Markets behave very differently depending on who owns the metal. When traders dominate, price is fragile and emotional. When users dominate, price becomes stubborn and unresponsive to fear. By the time this gap occurred, silver was no longer primarily held by people looking for a quick exit. It was increasingly held by entities that do not care about short-term volatility because they cannot operate without the metal. That shift is extremely dangerous for a paper-driven market. When buying pressure returned, something unusual happened. The sellers that normally appear simply didn't show up. There was no flood of futures contracts, no aggressive short selling, no wall of paper supply. Not because sellers forgot, but because they had already acted earlier. They sold into weakness, exited during fear, and stepped aside. When demand returned, there was nothing left to absorb it. Price didn't climb, it jumped. Not because buyers were emotional, but because sellers were absent. Markets can hide problems for a long time. They can delay consequences, smooth over shortages, and disguise reality with leverage and paper instruments. But gaps are moments when the mask slips. They reveal that the quoted price and the real condition of the market are drifting apart. That does not mean collapse is immediate, but it does mean the old rules no longer work reliably. And when rules stop working, behavior changes. This gap is not saying that silver is going straight up tomorrow. It is saying something far more important. The market is no longer confident that supply will be available later at a better price. That loss of confidence matters because confidence is the foundation of paper pricing. Once it cracks, volatility becomes structural rather than temporary. So the real question now is not why silver gapped higher. The real question is this: if the move wasn't driven by hype, retail enthusiasm, or speculation, who was willing to buy silver without hesitation, and why were they in such a hurry? That question is where this story truly begins. To understand what really happened, we need to answer the question most people are avoiding. If this gap wasn't caused by excitement, headlines, or retail traders piling in, then who was buying silver so aggressively that price had no choice but to jump? The answer is uncomfortable for the system because it reveals a shift in who actually controls the market. This gap was driven by buyers who don't speculate, don't chase momentum, and don't care about short-term price action. These buyers were not trading silver, they were securing it. In the financial media, markets are presented as transparent, orderly, and visible. Charts are shown, volume is analyzed, indicators are debated, but the most important silver transactions do not happen on screens. They happen quietly, off exchange, through private agreements between large buyers and bullion banks. This is the shadow market, and it is where real demand lives. When this market becomes active, the futures price doesn't lead, it reacts. The gap you just saw was the futures market scrambling to catch up to something that had already been decided elsewhere. Large industrial consumers of silver don't wait for confirmation candles or technical breakouts. They plan months and years ahead. They place standing orders that activate automatically when price reaches certain levels. These orders are not emotional and they are not optional. When silver dips into what procurement managers consider strategic territory, buying happens immediately. No hesitation, no debate. This creates a hidden floor under the market, one that paper traders cannot see but constantly collide with. At the same time, another group was being forced into the market from the opposite direction. Short sellers who had grown comfortable leaning on the silver price during periods of suppression suddenly found themselves exposed. A gap higher is brutal for a short position. There is no graceful exit. Stops don't trigger where you expect them to. Liquidity disappears. You're forced to buy at worse prices than planned, and every forced buy pushes price higher for the next one behind you. This is how gaps turn into traps. What makes this situation particularly dangerous for shorts is timing. This gap did not occur during a euphoric blow-off. It occurred after pressure had already been applied. Leverage had been reduced. Weak hands were gone. That means the usual supply that shorts rely on to exit simply wasn't there. When they tried to cover, they ran directly into buyers who were not price sensitive. That is a structural mismatch, and markets don't resolve those gently. There is also a psychological component that should not be underestimated. For years, silver traders have been trained to expect failure. Every rally was sold. Every breakout faded. Every surge met with paper resistance. This conditioned both bulls and bears. Bulls learned to take profits early. Bears learned that leaning on silver was safe. A clean gap breaks that conditioning. It introduces uncertainty into strategies that rely on predictability. And uncertainty is deadly to leveraged positions. The shadow demand behind this move is not chasing upside. It is running from risk. Industrial users are not buying silver because they think the price will go higher tomorrow. They are buying because the risk of not having silver later is becoming unacceptable. In a supply chain, price volatility is inconvenient. Supply disruption is catastrophic. As inventories thin and delivery times stretch, securing material becomes more important than saving a few dollars per ounce. That mindset does not reverse easily. This is where the futures market begins to lose authority. Futures pricing works best when supply is elastic and easily available. It breaks down when supply becomes tight and ownership consolidates. The more silver that moves into strong hands, hands that do not resell into the market, the less effective paper selling becomes. Each contract sold requires a buyer, and increasingly those buyers are entities that remove silver from circulation permanently. That is a one-way flow. As this transfer accelerates, volatility increases rather than decreases. The market becomes jumpy, reactive, and unstable. Small changes in demand cause outsized moves in price. Gaps become more common. Pullbacks become shallow. And every attempt to suppress price creates another opportunity for real buyers to accumulate. This is the feedback loop that breaks paper-controlled markets. What you are witnessing is not a breakout in the traditional sense. It is a loss of control. The silver market is beginning to behave like a market where supply matters more than leverage. That transition is messy, uncomfortable, and frightening for institutions that depend on predictability, but it is completely rational from the perspective of users and owners. So when you look at this gap, don't think of it as a sudden burst of enthusiasm. Think of it as the visible edge of a much larger transfer taking place underneath the surface. A transfer from speculation to necessity, from promises to possession, from a market that traded silver as a financial instrument to a market that treats silver as a strategic resource. And once a commodity crosses that line, it does not behave the same way again. One of the first questions traders ask after a gap appears is whether it will fill. This is a reasonable question in most markets because most gaps do fill. Price returns to the area it skipped, liquidity is restored, and the chart resumes something that looks like normal behavior. But that expectation is rooted in a very specific assumption, that supply exists at lower levels and that sellers are willing to re-enter the market if price gives them another chance. That assumption is now being tested. In a market where supply is plentiful and ownership is speculative, gaps act like rubber bands. They stretch and snap back. But in a market where supply is constrained and ownership has shifted toward users rather than traders, gaps behave differently. They act more like fault lines. They mark areas where price discovery failed, not because of emotion, but because there was nothing available to transact. When that happens, the market does not naturally gravitate back to the gap. It avoids it. This is why the current discussion about whether silver should fill this gap misses the point. The more relevant question is whether anyone actually wants to sell silver at those lower levels, and that answer is increasingly no. Industrial buyers are not waiting for perfect technical retracements. Sovereign buyers are not concerned with filling chart patterns. Long-term holders who survived suppression and volatility are not suddenly eager to part with metal because price moved too quickly. The conditions that cause gaps to fill simply are not present in the same way they were in the past. Historically, when silver moved too far, too fast, exchanges and regulators relied on familiar tools to restore order. Margin requirements were raised, position limits were discussed, volatility was framed as instability. The goal was always the same: slow things down, reintroduce fear, and give sellers time to emerge. But those tools are far less effective in an environment where the problem is not excessive speculation, but insufficient supply. Raising margins does not create silver. It only removes leverage. In previous cycles, removing leverage was enough to collapse price because the demand was primarily paper-based. Today, removing leverage simply accelerates the transfer of ownership. Speculators are forced out, and their positions are absorbed by buyers who are not using leverage at all. Each margin hike shrinks the influence of the futures market and strengthens the physical one. What once worked as a brake now functions as an accelerator. This puts regulators in an uncomfortable position. If they intervene too aggressively, they risk destroying confidence in the paper market entirely. If they do nothing, price continues to rise and exposes shortages. Either path leads to loss of control. The only difference is the speed at which that loss becomes visible. This is why responses now tend to be cautious, fragmented, and framed as temporary. The system is buying time, not solving the problem. As this dynamic plays out, another phenomenon becomes more pronounced: decoupling. Decoupling occurs when the quoted price of silver no longer reflects the price at which silver can actually be acquired. It begins quietly, with rising premiums and longer delivery times. Then it becomes more obvious as physical buyers pay above spot without hesitation while paper prices lag. Eventually, the two markets stop communicating effectively at all. This is not theoretical. It has happened before in other commodities under stress. When physical supply becomes strategic, the futures market loses its ability to dictate terms. It becomes a reference point rather than a clearing mechanism. Price discovery migrates to where the metal actually changes hands. The gap you just saw is an early signal of that migration. What makes decoupling particularly dangerous for the existing system is that it feeds on itself. As confidence in paper pricing erodes, participants demand more metal, not less. Inventory is drawn down faster. Liquidity thins further. Each attempt to stabilize price through paper mechanisms increases the incentive to bypass them entirely. This is how a market transitions from managed to chaotic without ever experiencing a traditional crash. At the same time, behavioral changes begin to appear. Producers become reluctant sellers. They hedge less. They prefer direct contracts over exchange exposure. Refineries prioritize long-term clients. Mints ration output. These decisions are not driven by price forecasts, but by risk management. When access becomes uncertain, optionality is hoarded. That behavior tightens supply even more. For traders accustomed to mean reversion, this environment is disorienting. Old playbooks stop working. Selling strength becomes dangerous. Shorting becomes asymmetrically risky. Volatility no longer offers opportunity so much as exposure. The market feels unstable because it is transitioning between regimes. It is no longer a purely financial instrument, but not yet a fully recognized strategic asset. That in-between state is where the most violent moves tend to occur. This is why attempts to call tops or bottoms based on historical behavior are increasingly unreliable. The past assumed elasticity that no longer exists. It assumed inventories that have since been consumed. It assumed confidence that has been eroded. When those assumptions break, patterns derived from them break as well. The gap is not an anomaly. It is evidence that the underlying conditions have changed. From a broader perspective, what is happening in silver reflects a larger issue across resource markets. Years of underinvestment, financialization, and just-in-time supply chains have left little margin for error. And when demand shifts even slightly, the system responds disproportionately. Silver, because of its dual role as a monetary and industrial metal, sits at the center of this tension. It cannot be printed, and it cannot be easily substituted. That makes control attempts especially fragile. So when you hear arguments that the gap must fill, or that the market will soon return to normal, understand what those arguments are really saying. They are expressions of hope that the old system still works. They are appeals to familiarity. But markets do not care about comfort. They care about availability. And availability is what is being questioned now. The gap is a warning, not an invitation. It is telling you that the conditions which allowed for easy entry, easy exit, and easy suppression are deteriorating. Whether price pauses, consolidates, or continues higher is secondary. The primary signal has already been sent. Control is becoming more expensive, less reliable, and more visible. And once control becomes visible, it becomes political. That is the stage we are approaching next. As control weakens and gaps begin to appear, the focus inevitably shifts from markets to institutions. When price behavior becomes erratic, authorities do not ask whether their assumptions were wrong. They ask how to restore order. Historically, that order has been maintained through regulation, messaging, and intervention. But what makes the current moment different is that the problem is not excess speculation or runaway leverage. The problem is that the underlying asset is becoming scarce in places where it is needed most. This is where the conversation stops being financial and starts becoming political. When silver was merely a trade, its price was an inconvenience. When silver becomes a constraint on industrial output, energy infrastructure, and technological production, its price becomes a strategic concern. At that point, the market is no longer just a market, it is a bottleneck. And bottlenecks attract attention from regulators, governments, and institutions whose priority is stability, not price discovery. The instinctive response in such situations is intervention. Calls for orderly markets begin to surface. Volatility is framed as a threat. Measures are proposed to calm price action and protect participants. But what these measures often do in practice is further distort the signal. By attempting to smooth over volatility without addressing supply, they increase the incentive for buyers to step outside the system entirely. Each layer of control pushes demand further into private channels, reducing transparency and accelerating fragmentation. At this stage, the futures market faces a credibility problem. Its purpose is to facilitate price discovery and risk transfer. But those functions depend on trust. Trust that contracts can be honored, that delivery is possible, and that quoted prices reflect reality. When gaps appear repeatedly, when physical premiums rise independently of spot prices, and when delivery timelines stretch, that trust begins to erode. Participants start to question whether the futures price represents an opportunity or a liability. This erosion does not happen overnight. It happens quietly, through behavior. Large buyers negotiate directly with producers. End users secure long-term contracts at fixed prices. Inventory is stockpiled rather than cycled. These actions reduce the volume available to the open market, which in turn increases volatility. The market becomes thinner, more reactive, and more sensitive to shocks. Gaps become not only more likely, but more meaningful. As this dynamic unfolds, the role of the individual participant also changes. In a stable market, participation is optional. You can wait, trade around positions, or exit and re-enter with relative ease. In a constrained market, timing becomes secondary to access. The question is no longer whether price will pull back, but whether metal will be available when needed. That shift in priorities is subtle but profound. It transforms silver from an asset into a resource. Resources behave differently than assets. Assets are priced based on expectations. Resources are priced based on necessity. When expectations change, asset prices fluctuate. When necessity changes, resource prices reset. That reset does not follow technical indicators or historical analogies. It follows supply chains, contracts, and strategic decisions. This is why attempts to analyze silver solely through charts increasingly fall short. The market is no longer being driven by sentiment alone. At the same time, narratives begin to fracture. Some will insist that the move is temporary, that markets always revert, that suppression will return things to normal. Others will argue that the system is broken and that price must reflect reality eventually. Both perspectives capture part of the truth, but neither fully accounts for the transition underway. What is happening is not a collapse of order, but a reordering of priorities. Stability is being traded for security. Liquidity is being traded for certainty. In this environment, volatility is not a bug, it is a feature. It reflects the market's attempt to reconcile competing demands with limited supply. Each spike and gap is a negotiation between those who need silver now and those who believe they can wait. Over time, the balance shifts toward urgency. That shift does not announce itself with headlines. It reveals itself through behavior, through the unwillingness to sell, the willingness to pay, and the refusal to rely on paper assurances. This is why the gap that initiated this discussion matters beyond its immediate price implications. It is a signal that the old equilibrium is breaking down, not because of panic, but because of planning, not because of emotion, but because of necessity. When planning overtakes emotion, markets become less forgiving. Mistakes are punished more quickly. Delays become costly. Access becomes a competitive advantage. For holders of physical silver, this environment demands a different mindset. The constant noise of daily price movements becomes less relevant. What matters is ownership and availability. Volatility may increase, but its impact diminishes when the objective shifts from trading to holding. The metal does not change. Its utility does not change. Only the system around it does. For those operating within the paper market, the challenge is more severe. Strategies built on predictability and liquidity struggle when those qualities erode. Risk models fail when gaps invalidate assumptions. Hedging becomes less effective when correlations break down. The tools that once provided control begin to amplify exposure instead. This is not because they are flawed, but because the environment they were designed for no longer exists. As we look ahead, it is important to understand that resolution does not come from a single event. There's no final bell that signals the end of suppression or the beginning of free pricing. There is only a gradual shift, marked by moments of clarity like the gap we just witnessed. Each moment forces participants to reassess their assumptions. Each reassessment moves the market one step further from the past and one step closer to a new normal. That new normal will not be comfortable. It will not be smooth. It will not reward complacency, but it will be honest. Prices will reflect availability. Risk will reflect reality. And those who positioned themselves early, not in pursuit of profit, but in pursuit of security, will find that they are less affected by the turbulence around them. This brings us to the most important distinction of all, the difference between holding silver as a trade and holding silver as a principle. A trade seeks to exploit movement. A principle seeks to preserve value. In times of stability, the difference is subtle. In times of transition, it becomes decisive. The gap was not an invitation to chase price. It was a reminder of why silver is held in the first place. The system will continue to adapt. Rules will change. Narratives will shift. New mechanisms will be introduced to manage volatility and maintain confidence. Some of them will work temporarily, others will fail, but none of them can change the fundamental equation. Silver must be mined, refined, and delivered. Demand must be met with supply. When those two forces fall out of balance, no amount of financial engineering can fully compensate. So when you step back and view this gap in context, see it for what it is. Not a breakout to celebrate, not a pullback to fear, but a signal to understand. It marks a point where the market briefly spoke plainly, where price moved not because of opinion, but because of necessity. Those moments are rare and they deserve attention. In the end, silver does not need belief to function. It does not need narratives or forecasts. It exists as it always has, indifferent to systems and policies. What changes is how humans organize around it. The gap was a small moment in price and a large moment in meaning. It reminded us that control is conditional, that confidence is fragile, and that reality eventually asserts itself. As this transition continues, the noise will grow louder. Opinions will become more polarized, volatility will test patience, but beneath all of it, the same truth remains. 1 ounce is still 1 ounce. Its role has not changed, only the world around it has. And in times like these, understanding that difference makes all the difference.